This is InvestTalk. Independent thinking, shared success.
Hi, I am calling about Kraft Heinz Company, ticker KHC. I was wondering if I could get some insight about this company and what you thought about it. I'll be listening on your program. Thank you for all the good information. Thanks. Bye.
This is the company that you think of. We're talking about they own Oscar Mayer, Velveeta cheese, Philadelphia cream cheese, obviously Heinz ketchup, and all their condiments. And it's a huge company, huge brand, $33 billion market cap. However, the problem here is that they have a large amount of debt, about $20 billion in net debt. And they have a high dividend, 5.7%. But I don't like that debt profile. And their cash flow has peaked out. It peaked out in 2021, and it's been declining ever since. Now, not aggressively, to be fair. It does have about $3 billion in free cash flow, but on a $52 billion enterprise value, that's not a very good free cash flow yield, especially for a company whose earnings and sales are floundering. Last quarter, revenues were down 6%. Earnings were down 10%. And that doesn't look like it's changing this year going forward. Total earnings this year are expected to be down 15%. And analyst estimates for this year and next year continue to go lower. So I don't like the trends here. I don't like the debt. And the chart is not making me feel all warm and fuzzy either. It's in a strong downtrend. It's been trying to reverse, and every time it gets to the 100-day moving average, it fails. And so it's just sitting there in a bearish setup, looking to go lower. And when you have that much debt compared to its market cap, it's the market signaling that this is a company that likely will eventually cut their dividend. And they had some accounting problems before, and they've already cut their dividend. Actually, if I look at it, their dividend was 62 cents per share back in 2018. Now it's down to 40, and it's been flat ever since. And like I said, they had some accounting issues, I believe, back in the day. I just don't like those names. And then you look at profitability, return equity, only 5%. And it's been hanging out around 5% since 2016, so nearly a decade. So this is a perfect example of a value trap, if you want to call it that, a dividend trap. This is a dividend trap. That might be a new word I'm going to use a lot. A dividend trap. People look at the dividend and they think that this is all rosy. Oh, a nice 5.7% dividend on this kind of blue chippy type of brand. Let's go for it. The reality behind the scenes is very different. It looks bad, straight out. And so I would absolutely sell, not buy. It's a better short than a buy. So passing big time on Kraft Heinz.
Unlock valuable financial insights and strategies by signing up for the KPP Premium newsletter.
Hi, Justin or Luke. I'm calling today about a couple industrial companies, Graham Corporation, ticker GHM, and Graco, ticker GGG. Just wondering if you would hold these companies in today's environment. Let me know if you think I should sell out of them or just keep holding on. Thank you very much. Love the show. Bye.
All right, looking at two industrial names. I'll start with the second one first, and that was Graco, manufacture equipment to move, pump, meter, mix, and dispense fluid and powdered materials. And this is a name that we actually used to own for clients, but we kind of got impatient with it. It didn't really move much. It was kind of neutral, hanging around this mid-80s level. And we held it for a period of time, but couldn't get a clear direction on it and sold it. We liked the business, but we just found better use of that capital. So, if you go look at profitability, it is solid, about 20% return on equity and return on invested capital. They have pretty much no debt, net cash on their balance sheet, really. Good free cash flow, around $550 million on a market cap of $13 billion, which puts you at about a 3-4% free cash flow yield. Solid, but not amazing. Dividend yield about 1.3%, and they're taking that cash flow and they are buying back shares. So we like the cash flow, or the shareholder yield here. We like the profitability, but I think the biggest issue is just the growth. There's not a whole lot. Earnings growth this year is supposed to be 6%, 7% next year, and the trends in earnings growth are coming down as well. So that was another issue that we had, is So that was the issue with Graco. A fine company, but not. We ended up kind of falling out of love with it. And then Graham Corp manufactures vacuum and heat transfer equipment for the petrochemical and oil refining businesses. And this has much better earnings growth, 42% revenue growth, earnings growth for this year, 16% expected next year. It's much smaller, only a $380 million market cap. So you're taking much more risk than you are with Graco, but you're getting better earnings growth. Now, let me take a look at the profitability here. It's not as profitable, only 8% return on equity. It has a good balance sheet as well, no long-term debt. Free cash flow, though, only about $18 million, but, on a market cap of only $380 million, that's not too bad. It's about a 4-ish% free cash flow yield with pretty good growth. The technicals are much better. It has pulled back, but it's finding its footing once again. So if I'm going to pick one or the other, I do think that longer term, Graco just has a more consistent business. But in the near term, as a trade, I would probably go with Graham. Both are solid. I love that fact that both have a very strong balance sheet. And so it just depends on the risk that you want to take. Is this more of a trade or a long-term hold? Thanks for the call. Now, on Fridays, we generally make time to fit in a quick rundown of some key benchmark numbers. So let's do that right now. The 2-year yield, 3.878. That is up from last week, which was at 3.836. So up about 4 basis points. And that was after the Fed meeting. And markets are basically anticipating a less dovish Fed going forward, marginally. Now, the 10-year yield up to 4.37%. That's up about, about 5.5 basis points on the week. Last week it closed at 4.314. So once again, rates are going up across the curve. Sometimes in a minor way, sometimes in a major way. But either way, this is something I'm watching. Are we going to get a break above the 4.5% level on the 10-year, up above 5% on the 30-year? Those are things I'm watching, and that could be a major drag on asset prices. Gold was at $3,337 per ounce. That's an $11 increase from last week. And 78 weeks ago, it was at $1,935. So very strong move and is in a strong uptrend. Silver, $32.79. That's up about less than $1, 75 cents from last week, but still up dramatically from about a year ago when it was at $22.80. Oil at $60.94 per barrel. That's a $2.79 increase from last week. So like I said, even with that OPEC news, it really did okay. And we kind of remain in this range around $60 per barrel, 65. And I think that's where we'll be before we get some resolution to kind of broad demand. And, are shale names going to continue to pull back from their CapEx? And if they do, that's going to put a big floor under oil. Gasoline on average for the country, $3.14 per gallon. That's down 4 cents from last week. And in California, our price is $4.84, a 7% increase compared to last week. So we're definitely feeling it more than the rest of the country here. As comparison, Missouri, $2.81 per gallon. That's your average. Over $2 less than what we're paying here in California. Now let's keep things moving and play another listener question from 888-99-CHART.
I love the show. Wanted to get your take on WW Grainger Incorporated, G as in George, WW. Just wanted to see if you thought it was a good long-term investment play, and if so, if you thought it was at a good entry point, or if not, what you thought a good entry point would be. Thank you very much.
All right, looking at GWW, which is WW Grainger, and this is a distributor of maintenance, repair, and operation products for the industrial space. And they have over 5,000 suppliers. So the suppliers sell into them and then they distribute the products. And they have 300 global branches, so they're worldwide. About a $50 billion market cap. Very minimal debt, that's good. Return on equity, 51%. Free cash flow, about $1.5 billion on about a $50 billion market cap. That's about a 3% free cash flow yield. That's not an amazing value from a free cash flow perspective. And if you look at enterprise value to EBITDA, it's around 18, near the high end of its range. And if I'm looking at profitability or profit growth, shall we say, last quarter, revenues are up 2%, earnings are up 2%. This year, earnings are expected to be at 4% and then 10% next year. Although both of those estimates are trending lower. So that's what worries me, is that you're paying a pretty hefty multiple, mid-20s multiple. It's trading over $1,000 per share. And if it's only making $40 this year, it's about a 25, 26 multiple. Now, if I look at the chart, it has peaked out recently around $1,200 or so and change. It was in a downtrend going into Liberation Day, sold off, but it's actually up since Liberation Day. So you're seeing some relative strength there, but overall it's in a nice downtrend. And I don't love the technicals. It found support at the 100-week moving average, which historically it has found support. But if you go into a recession, I think this has more downside potentially to go. Now, where would be the price that I would think about picking it up? Let me give you a number here. Well, then major support would be around $820 per share. That would be the first major support that would get interested in this name. Around 700 would be that next level of major support, and there's massive support around 565. So those are my levels. I do think it gets to 820, and I would start a position there and see where we're at economically. But I don't love the trends. I don't like the overall valuation here. It does look expensive as we go into an economic slowdown. So keep it on the watch list because it's a great business, great company, great balance sheet. But I'd be patient on picking up Grainger till at least 820. Now let's touch a bit on what Wall Street is looking at when we are trying to decide how much impact these tariffs are having on the overall economy. Now we look at things like ports, what truckers are saying, what railroads are saying in their earnings outlook, what shipping and logistics data is saying in those companies. And the main one, especially because we're dealing with basically a China embargo, is container imports in LA and Long Beach. Now, one thing to understand is that going into Liberation Day, there were an elevated number of containers coming into those ports. For January, there were about 950,000 containers. That's up from the January of 2024, when it was only around 760,000 containers. So about 200,000 more containers just in that 1 month. February, the difference was not as stark. It was at about 77,000 containers versus about 770,000 versus 740,000 in February of 2024. And in March, there were about 760,000 containers coming into those ports versus the March of last year, it was about 680,000. So the big difference was January, but there's still a pretty stark difference in February and March as well. We don't have the full data for April, but we'll be watching for that to see how many less containers there will ultimately be, to ship. And we're getting more indicators from retailers, even though they're stocked up, they are likely to see these imports impact the shelves sometime in June. Now, China to US bookings declined 60% since April. And overall in the port of LA, imports are expected to fall 35% this week compared to a year ago. And the container ships expected at Southern California ports in the following 2 weeks, expected to be down to about the May 5th week, this is this week, 43 ships in the LA ports. That compares to a range between the low end 50 and the high end 70 for the past, basically since last summer. And we've been in this mid to low 40s since April 23rd. Now, on the trucking side, net orders for heavy duty trucks in North America were down to 16,500 vehicles in March. That's down 5.9% from the same month last year. And it's the highest order cancellation rate in almost 2 years. And if you look at dealer inventory, reached record high levels to 91,600 vehicles in March. Now, S&P Global has a monthly survey of 27,000 businesses in 40 different countries, and it makes up their global supply chain volatility index. And that was actually in negative territory in March. So this takes into account factors like demand for goods, inventory levels, transportation costs, etc. And we know that it's going to pull back even further due to worsening economic conditions in April. So we're watching to see what that number looks like. And then the Dow Jones Transportation Index. And it's underperforming the Dow by 9 percentage points this year. And these are companies that have to do with shipping, railroads, logistics, etc. That 9 percentage points up to this time in the year is one of the worst showings in the past decade. So we continue to look at the reports from companies like J.B. Hunt, Matson, Knight Transportation, etc. And those are the areas that we're focusing on to see what type of real world concrete impact this is having on businesses. And it is profound. And it really can't be ignored. And that's why I do think that there is a recession. But, right now what's happening with businesses is they're pausing. One of the big reasons for the rebound in equities since the low is actually buybacks. Why? Because they don't want to hire people. They don't want to invest in R&D and CapEx to build out capacity because there's just too much uncertainty. So what do you do instead? You have money burning a hole in your pocket. You've already approved share buybacks from your board. Buy back shares. Now, the strongest correlation with unemployment is corporate profits. When companies start to see margins shrink, profits shrink, one of the first things they'd start to do is actually lay off workers. They haven't felt that in a big way yet, but the longer this stays with us, the more likely these hiring freezes will turn into layoffs.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos.
Now, from time to time, we receive InvestTalk questions from the YouTube comment section of our InvestTalk channel. So let's tackle one of those questions that just came in. Gil Tel Aviv says, I'm looking at investing in AppFolio as it seems well positioned to benefit from real estate growth. I'd love to hear your thoughts on the property management software space overall and how AppFolio stacks up against its competitors. APPF is the symbol, and it is about a nearly $8 billion market cap. Earnings growth is solid, although it is slowing down, and that's my biggest worry here. I've looked at this name over the past couple months, and you had earnings growth last year of 156% to $4.37. But this year, earnings are expected to be only $5.18. That's a 19% growth. So dramatic slowdown in growth here. A year and a half ago, revenues were up 39%. Earnings are up over 1,000% year over year. But the latest quarter, revenues up 16% and earnings up 15%. Solid, but what type of multiple are you going to pay for that level of growth? Trading at $214 per share. And let's say, even though estimates are coming down for next year, let's say it earns $6 next year. Are you willing to pay 25 times? 30 times? Let's say you're going to pay 30 times $6 per share. That puts it at $180 per share. It's at $214 today. And those estimates are coming down, as they normally do. A little farther out, you look for at earnings estimates, the less faith that you should have in them, because they do tend to trend lower. Now, the good thing here is they have a good balance sheet, zero long-term debt. Free cash flow is $178 million. That's good. But it also has really leveled out here around $170 million for the past few quarters, which puts it at a free cash flow yield of only 2.5%. Not great. It's profitable, 46% return on equity. That's good. They're starting to buy back shares. I like that. But it's just trading at too high a multiple. Price of sales at 9.5. I always say anything over 10, usually pretty egregious. Enterprise value to EBITDA, 48 times. That's very high. You want that usually in the teens. And then I look over the chart. And this has really not done well over the past year plus. It peaked out around $275 per share. And that was back in July of last year. Sold off, found a low around 190, rallied back up to around that 275, made a double top, slightly lower, higher high. So technically, it's in a downtrend. Did I say lower, higher high? That didn't make sense. A lower high. There we go. And it's been in a downtrend really since last July. It's had a recent sell-off. It's bounced back, but it's trending lower. This isn't a downtrend. This is on its path towards a multiple contraction. And that's why I wouldn't buy it. It would be on my radar because I do like the business and I would like to buy it at a reasonable price. It's just not there yet. And I think there's a lot more downside to go. Honestly, I probably wouldn't look at this until 175. There is good support around there. that's where things get somewhat interesting. But I don't really love it until about 140. I would really love it around 110. But, I kind of have to see this, so how it evolves, how the technicals evolve, how the growth evolves. Does it turn into just a single digit earnings grower? Then you're getting massive multiple contraction, and you probably see the 110 level. So name I would just continue to watch, but I wouldn't be buying it right now. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And if today's show made you think about your own financial picture, your investments, taxes, retirement, and whether it's all really working together, let's talk. At KPP Financial, we offer no-cost portfolio reviews to help bring clarity and confidence to your financial picture. Just go to investtalk.com and click on Portfolio Review. Over the weekend, visit our new online store. Just go to investtalkstore.com. Independent thinking, shared success. This is InvestTalk. Good night.